Hi everyone. So today me and Jason is going to talk about the topic money and finance. We hope that you guys will learn something out of it and hope you guys enjoy.
Contents. For the first part of our presentation, it will be why do we need money and what is money? That will be page 3 and 4. For the second one, it will be what is bartering and the problems. That will be page 5. For the third one, it is history of money, which is page 6. The next one is functions and characteristics of money. That will be page 7 and 8. The fifth one is the money market and types of banks, loans, and accounts. That will be page 9 to 12. The last one will be the stock market and how the stock exchange works. That will be page 13 and 14.
Now I'm going to explain why do we need money. If we don't have money, how are we supposed to pay our goods and services? Back then, we didn't have money, so they had to exchange goods and services they produce as a form of money or payment. Long time ago, since people have different skills, they will exchange goods and services that they are able to produce. Specialization helped the society to build wealthier.
First of all, money is a medium of exchange of goods and services. Money is anything that are basically used as a means of payments and is generally acceptable in the settlement of debts. In other words, money is something that is freely used and accepted as a medium of exchange and or as a unit of account. What is barter and the problems of bartering? Bartering is exchanging goods and services to one another. There are three main problems for barter. The first one is fixing rate of exchange. The photo beside you will show that bartering is a problem. How many pencils are worth one apple, and how many oranges are equivalent in value to one ruler? This keeps going on. So, in a barter system, the value of each and every good must be expressed in terms of every other good. Second problem is finding someone to swap with. In this case, an economist would say no double coincidence of wants exists. In other words, before two people can barter, they must both want the good that the other person has. So for example, if I want a cheese and the other person wants an apple and I have that apple, we must both want the good that the other person has. The last one is trying to save. A final problem is how to save under a barter system. Barter is therefore a very inefficient method of exchange. Clearly, it would be much easier if there was a single commodity or good that everyone was willing to accept in exchange for their labor and all other goods and services.
Now I'm going to talk about the history of money. There are 5 stages that money was formed. The first form of money was actually goods, so back then we had to accept and exchange goods and services instead of money. The second stage is metal like silver and gold was scarce as a form of money. Basically, metals were used as a form of money, but they were too heavy to bring around. Third is metal became stamped with the face of the king and queen, so they can help show the value of the money, but the problem is that they're usually only used for special occasions, so it's not applicable to everyday life. After that, the paper money was issued by goldsmiths. Goldsmiths are people who specializes in working with gold and other metals, and they produce paper money. And then paper money was produced. So now I'm going to talk about what is the function of money. Money is a medium of exchange. It's generally acceptable in exchange for other goods, and it helps us overcome the double coincidence of wants. Second, money is a measure of value. It helps show the value of the goods and services that we have, and we will be able to compare the value of the different goods and services in our everyday lives. Third, money is a store of value. It can hold its value when time passes by. And fourth, money is a mean of deferred payment. Deferred payment is basically another form of payment is when someone will pay on a later date after they bought the good. Moving on, we're going to talk about the characteristics of good money. First, it has to be acceptable. If it's not acceptable, then we won't be able to get the goods that we want. Second is durability. They need to be strong and durable because they will be acting as a store of value. Third is portability. Money should be easy to carry around, so just in case there's an emergency, we could just get money from our pockets and we can get our goods and wants that we need. Fourth is divisibility. It must be possible to divide the money of a large value into smaller values. to make small purchases or to give change without losing its value, so it'll be easier for them to pay their needs or wants. Fifth is scarcity. Money needs to be limited in supply so people can value it as a good that can be used in exchange.
The money market. What is the money market and what is it made up of? The money market is basically where firms or people or governments meet somewhere they can keep their money safely and to make it easier for them to take their money back or to make investments or to maybe exchange the money used in their country for the currency used in another country so they can make other payments. And a money market is made up of all those people and organizations that want money and all the people and organizations willing and able to supply money. For example, a banking system that deposits money, or a central bank that issues notes and coins. Banks. First of all, what is a bank? Banks are like any other business, but the product they supply is money. A bank is a financial intermediary because it brings together customers who wants to maybe borrow or save some money. Banks are among some of the world's largest corporations in terms of their revenue, profit, or number of employees. Banks will accept deposits of money and savings from their customers, and they will make loans. Types of banks. The first bank is the commercial banks. Commercial banks help small and large businesses with financial services. They accept deposits and offers checking account services will help make personal deposits. And commercial loans help exchange foreign currency for mostly traveling, but they will also provide insurance and many more. The second one is credit union. They are NFPO or not-for-profit organization, and they are owned by and for its members. They offer higher saving rates and lower interest rates on loans. Since they're not focused on making profits, they are focused on covering their operating costs instead. Credit unions are able to offer better interest rate to their members. The third one is mutual societies. Mutual societies specializes in providing mortgages, or aka types of loans to buy a property, but now they offer a lot of commercial banking services. The fourth one is investment banks. The investment banks help organizations to raise finance so they can raise finance, usually to help sell shares and stocks on stock market. The fifth and last one is the Islamic banks. These banks don't allow interest charges and payments, and Islamic banks make available accounts which provide profit or loss. Types of account and loan. Types of accounts. The first type of account is deposit account. It is a saving account or a bank account. It allows people to deposit or withdraw money. The second one is current or checking accounts. Current or checking accounts are for people to get their wages from their jobs paid into that specific account. The third one is savings account, where people can obviously save money in their account. So basically, the more money we save, the more the rate of interest will be paid to us. Types of loan. The first one is an overdraft. It allows the people to overdraw, which means they are allowed to draw more money than they're supposed to. The second one is a personal loan. You repay the money that you borrowed with interest. The third one is a commercial loan. It's a loan to a business to pay for the machinery and the materials that are being used by the business. The loan is also repayable with interest over a period of time. The final one is the mortgage. A mortgage is a long-term loan because it is used by people that are used to buy a property. The loan is secured against the property, so if the person doesn't pay for the mortgage, the property will be sold to repay the debt for the mortgage.
The stock market. What is the stock market? It's basically a place where individuals buy and sell shares. A person who buys and holds shares is called shareholders. Buying stocks basically means that we're gonna get some part of the business. Basically, we're going to take ownership of it because we already purchased the stock for that. And they're not usually stock exchange are not usually open to the general public. They have to contact a broker that is a member of stock exchange. Brokers are usually the people who arrange transactions between a buyer and seller. As you guys can see, this is a FTSE chart, and it shows how the prices change over time. As you guys can see, in year 98, 99, it's going up and down. You guys can see the price changes, and individuals and companies can also make money on the stock market by guessing which way share prices are likely to increase and decrease in the future, and helps investors also compare the past prices with the current prices to calculate the market performance. So now, moving on, we're going to answer questions from past papers about money and finance. So first, we're going to answer a 4-mark question, and then we're going to answer a 6-mark question, and in the end, we're going to answer an 8-mark question. First, we have to explain how money functions as I, a unit of account, and I as a standard of deferred payment. So we all know what the meaning is. First, I think we need to define the meaning, so because it equals to 1 point. So for I, it says a unit of account. A unit of account, it helps people compare the value of different goods and services, as we mentioned before, and it helps determine the value of goods and services, which deferred payment is when someone will pay it on a later date. This is another form of payment. So we could add that as our first sentence. And second, we just add up the reason why, how money functions as a unit of account and a standard for deferred payment. So I said for I, this helps people to compare the value of different goods and service. That's what it means. So people will know which one is worth buying, and money places as a value of an item. This is how I answered I. This allows people to borrow money first, and deferred payment will also allow people to pay the amount that needs to be paid in the future. Now second, it's worth 6 points. Explain how an improvement in financial service might help to reduce poverty. We have to define what the keyword is, which is poverty and financial service. So this is how I defined poverty and financial service. Poverty is a situation where people are not able to satisfy their needs and wants due to lack of financial support. And to add up, financial service is a service that provides service for investment. And this is my reason why, how an improvement in financial service might help reduce poverty. People will have more access to money and therefore will have more purchasing power. Through financial service, it will give opportunities for business to borrow loans for the business. Through enlargement of the business, there will be more job opportunities created and more employment. And when there's employment, more people will have income that allows them to have a higher purchasing power to fulfill their needs. For example, when people experiencing poverty borrow money, they will be able to use it for their necessities such as food and clothing. And this will result in more people being above the poverty line and therefore reduce poverty. So now we're going to move on to question 8, the third one, which is 8 points. We also have to define the key terms here, which is wages. Wages is a money paid to a worker for work performed. It may reduce profit because labor cost exceeds labor productivity. So basically, I'm explaining how wages in a firm would reduce its profit or not. There could be a yes or no. I think it's better to mention both. So this is why it may reduce profit, because if labor exceeds labor productivity, it can reduce profits because workers are not even making a lot of the output. The cost of production may also be high, but the output's not a lot. It also may not reduce profits because with an increase in wages, it also helps motivate the employees to do better in their jobs. So with more productive workers, it could help produce more high quality products and could make them work faster. So it could help the business to get more profit, and they could also get more trained and skilled employees if they have higher wages because it attracts them. So thank you for listening. I hope you guys learned something out of it. Thank you to Mr. Allen, God, and parents for making this project possible.